Good evening and welcome to another Tuesday videocast. Welcome all. My name is David Etienne. My company, Etienne Business Solutions. We are a certified public accounting firm and we're located right here in Georgia, Conyers, you name it. But in addition to the general company, which is Etienne Business Solutions, we have our YouTube channel where you can find a whole host of information. So I know, yes, making connection with the office to speak to an individual myself or maybe my staff may sometimes work. But in the absence of that, there's a whole list of videos on our YouTube channel, Etienne's Place, that you can check out and get a lot of information on a wide spectrum of business topics. So I encourage you to check out my channel, Etienne's Place. Like, subscribe, share, leave your comment, and be informed. Okay? Great. So today we're going to be focusing for a couple of minutes on this whole concept or this whole thing called individual retirement accounts. Individual retirement accounts. All right. Most individuals are aware, because most of you guys also have such accounts. However, it takes a little doing to navigate through all the different, through the nuances of the various types of retirement accounts. There are certain guiding rules, guiding principles, and so someone, sometimes say, I think I want to take out an IRA. Yeah, that's a generic IRA, but in the in the land of IRAs, you have quite a number of different types of IRAs that have different conditionalities, different pros and cons, and sometimes it's worthwhile to be aware so you know exactly what you're getting into. Okay, let's jump right in. Usually the question is asked, can I, what's it basically, first of all, what is the difference between a 401k and an IRA? What is the difference between a 401k and an IRA? And it's as simple. Both are retirement accounts. It's just that your 401k is what your job, your employer, the company you work with, is going to establish on your behalf. Okay, so 401ks are established by companies on behalf of their employees. IRAs is another retirement account that you and I, as individuals, can just go to a bank or a brokerage firm, wherever we go, and say, hey, I'm here to open an IRA account, so to speak. Right? So that's a basic difference. So the next question that usually follows then is, which is more beneficial, to have a 401k or to have an IRA? Again, there's no yes for this and no for that. No, there are a number of things that ought to be considered. However, two things that will always be constant and true is that with a 401k, number one, your contribution limits are more flexible. In other words, you have higher contribution limits with a 401k than with an IRA. Okay? That's one thing. On the flip side of the coin, with an IRA, you have more flexibility in terms of the management of your money. You can decide, what to do, how to do, if you want to take, if you want to, invest it however you want to. So there's a lot greater flexibility in how you handle your IRA and what you can and cannot do as compared to your 401k. Because, as I said, 401k is provided by your employer. They control that, and usually those 401ks are what we call managed accounts. Let's call it that, because the administrator of the pension plan or whatever it is are the ones who monitor, who manage. They're even the ones who invest the proceeds of that account into whatever investment vehicle they so desire. What you'll find sometimes though is that sometime maybe around the anniversary or annually, I'm not too sure, you find that your employer may give employees an option to say, okay, your money has been invested in these, in this portfolio, in these different securities, etc. So, and usually they come like a plan. Plan A carried this batch of security, plan B, plan C. And sometimes you're given the option to say, okay, currently you're in plan A, but we're giving you an opportunity now to make some changes. But once you make those changes, you're locked again into that plan. So as I said before, 401ks are stricter in terms of management, whereas your IRA is something that you actually own, and so you do whatever you want with it, so to speak. So that is it. You can have both a 401k and an IRA. The other question that sometimes asked is, if I have a 401k at my job, can I then participate, in an IRA outside of that? Which might sound similar to the first question, but there's a subtle difference here in that the answer is yes and no in terms of not so much whether or not you can contribute, but how much of that you will be able to be a tax deductible item. So in other words, if you are already covered by employer plan, or if your wife, your spouse, works at a company and there's a coverage already, or 401k already covers herself, family, whatever the case is, then you may find that you are allowed, yes, to have a separate IRA, but the contribution may be restricted in terms of income speculation. So those are some things to consider. But yes, you can have both that and the other. Okay, so one is that yes, you have it, but you may not be able to deduct. That's really what happened. You may not be able to deduct all of your contribution into this IRA, given the fact that you already have a 401k coverage there. All right, and on the other hand, too, you will find that your contribution limit may be restricted based on income. So those are some considerations that are at work. So then, the question about is it better for one or the other, as I said earlier, there are pros and cons. And for those who are employed and your employer carries a 401k plan, then yeah, the no-brainer decision is to go with it. Okay? Individuals who are self-employed, then of course you have no option but to open your own IRA account. Now the good thing about it, which we'll come to a little later on, is that there's a type of IRA account that almost mirror the normal employer 401k, because that IRA is one that you, as a self-employed independent person, can have your company. Let us say that you're an electrician and you decide that you want to open your own business and you're doing your own thing, so you have your little company. Then you can have your company establish an IRA account on your behalf, and to a large extent that now makes sort of mirror what a 401k would be like. Not quite, but something pretty similar. Pretty similar. Good. So let us then look at some of these. Can we hear these terms all around? This type of IRA, that type of IRA, etc., etc. This is the tax implication of IRA Plan A as opposed to IRA Plan B. So let us look this evening at some of the more common ones. Now, the first one that comes to mind is the traditional IRA. And for the traditional IRA, these the contributions into a traditional IRA is normally tax deductible. Very important to note, right? Once you contribute to a traditional IRA, then those contributions are tax deductible. So what it is saying is that you pay no taxes on the IRA earnings. Okay, so you have this IRA for year 1, year 2, 3, 4, 5, 10, 15. It is earning, yes, dividends, whatever, because it's an investment. It is earning for you, but you pay no taxes on those earnings until no, it's not that you fully get away. Until it is time for you to have distribution. So once again, the traditional IRA is where your contributions are typically deductible. Tax deductible, okay? So you pay no taxes on the earnings until retirement, and then of course at retirement is when you're going to be withdrawing those your pension money, your retirement money, and so at that time they will be taxed. Those withdrawals will be taxed. But the beauty about it is, and I guess some of my listeners here are experiencing that benefit, is that years back, well, before I even say that, the reason for your distributions at retirement to be taxed is simply because when you had put it in the IRA, it was, as I said before, tax deductible. You get me? So in other words, no tax hit you. It's a case where the money was put there, it earned additional income, it grew, so the account grew and grew and grew. Now you're at retirement and it's time for distribution. And so we'll have to pay taxes. So what I was about to say is that the beauty about it is that at retirement, most taxpayers would find themselves in a lower tax bracket at retirement than they were during the active years of work. Naturally, because let's say that you were the marketing manager for an organization and you were earning money, plus you have some other things that you used to do, as additional work, whatever you do. So your income was at a level that would cause two things to happen: that you'd be in a high tax bracket, and you know how tax brackets are, depending on the bracket in which you fall. We had discussed at some time back. Bracket in which you fall, then it will determine what income bracket you fall, determine what is that bracket's tax rate. So at the time, in the earlier years when you're earning a lot of money, you'd be in the high tax bracket, and so you'd have been maybe in the 20-25% tax bracket. Now you're retired and you're getting your distributions from your IRA, it will be treated as ordinary income and it will be taxed at ordinary income rate. But of course, since you're not earning those mega bucks anymore because you're retired, so currently at time of distribution, your tax rate could be way down into the 15% arena. And so all those monies that avoided at 22%, 25% tax years back are now returning to you with income earned, and yes, taxable, but not taxable at the 20-25%. Taxable at your today's tax rate, which would be, as I said, maybe just about 15 or so percent, because your income has gone significantly lower. You're retired. And it is true, so that some retirees still do a little thing on the side. But even then, even with those little additional income coming in as a result of of little work here and there, would not put you in any high income bracket. Cool. So that is traditional IRA. That is the traditional IRA. Let's now go to the other one that people speak about quite often. Is a Roth IRA. Okay, Roth IRA. Now the Roth IRA is the opposite when it comes to taxes. So with the Roth IRA, the contributions into a Roth IRA are made with after-tax money, after-tax fund. So back up a little bit, your normal employer-sponsored 401k, into which you also contribute, that is pre-tax, meaning your income is $1,000, the amount is taken out to put into your 401k or into the traditional whatever, and what is left after is taxed. So the money that goes into that account, the retirement account, is not taxed, and the earnings that account gain over time is not taxed. At distribution, that is when you deal with taxes. When we come now to the Roth IRA, the opposite is so, because Roth IRAs are funded with after-tax dollars. So typically, if you take out a Roth IRA, after you get your paycheck, you're going to take some of your take-home pay and decide, okay, I'm going to put that into a Roth IRA. But of course, your take-home pay is a balance after all the deductions, including income tax was withheld. So your take-home pay is all after-tax money. Okay, and that is what you would use, or you would use money from that take-home pay to fund your Roth IRA. So Roth IRA contributions are made with after-tax money, after-tax dollars. So because they were made with after-tax dollars, then it means that because they were made with after-tax, there's no further tax to contend with. Okay, so that is your Roth IRA. So that there's no tax deductibility, and so the earnings, and with the earnings and the withdrawal of earnings at later years would then definitely be tax-free. Okay, right? So earnings and withdrawals are tax-free because you had funded that account with after-tax dollars. So that is your Roth IRA as opposed to what we refer to as your traditional IRA. Fine. Let's go to the simple IRA. That simple IRA is the one that I said almost mirror, that 401k thing. So the simple IRA is used by small businesses. Quite often you'll find small businesses use that simple IRA. Since they don't get into those large retirement saving plans, so they just use that simple method. The word, although it says simple is actually an acronym for one long drawn out thing, which stands for savings, incentives, match plan for employees. Long drawn out word, okay? So it's just called simple, a simple plan. So in this plan, you find that both this plan allowed both the employer and the employee contribution to be treated similar to how a 401k would do it. But the beauty about the simple plan, as the word suggests, the administrative work, the paperwork is much less, much simpler, and so less costly in terms of the administration of such a plan. So a simple IRA, administrative wise, it's a simpler process, easier to set up, so small businesses tend to gravitate towards that. But the beauty about it is that it is so similar to a 401k that, if you cannot really get onto the 401k band, that simple IRA is definitely the way that you'd want to go. The next one I want to look at is what we refer to as a SEP IRA. SEP, SEP IRA. That is one type of retirement account that, again, a number of small businesses will get into. And one of the greatest, I would imagine, advantage to this IRA, SEP IRA, is that you get in my view, you get a double benefit. Because as indicated earlier on, with a SEP IRA, it is your company that established this IRA account on your behalf. Because remember now, as the owner of this company, you wear two hats. Yes, you're the owner. At the same time, because you operate as a CEO, you're almost like an employee of the company. So you own this company and you work in this company. And that is why your compensation from this company usually can fall under two headings. One is a salary. You can earn a salary from your company, separate and apart from you getting what we refer to as distribution from this company. And distribution from your company to you is similar to dividends that large corporations would declare to their shareholders, because effectively you are a shareholder, just that you're maybe 100% shareholder, but you are shareholder of your own company. Now, mark you, I'll just touch on this a bit. If you just establish, or if you have limited liability company that you register, you may not be able to tap into those benefits and advantages. But if you move to the point of establishing your thing as a S corporation or C corporation, then yes, you can tap into those benefits. So if that is the case, then as we said before, the benefit is that the company is the one who is going to establish this SEP IRA account on your behalf. So by virtue of doing that, the company will treat the payments to the account as a normal business expense. A normal business expense. So if $5,000 is what is contributed into that SEP IRA account by your company for you, then the company is able to take a normal business expense deduction on its P&L. That's a big benefit. On the other, and also you are having a retirement account funded. Okay, so you're building up your retirement account by the company doing this, paying the contributions, and the company is able to take a full write-off, a deduction as a normal business expense for this SEP IRA. So a lot of small businesses gravitate to that, and it's something that, you know, if you're a small business and thing, you may want to explore that option to see if that is something that you'd want to get into. I'm just simplifying things so you get a handle as to, you know, how this thing works and the things that you ought to be aware of at the micro level, you know, the surface level. But of course, if you have an interest in getting a plan, establishing a plan, having your entity open a plan for you, then yes, you'd want to speak to someone to get a lot more details in terms of the pros, the cons, what are the things that you should consider. But this is just for you to be aware of the different types and basically what they carry, what they offer. So that is your SEP IRA, and that is a very, 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 very heavily used IRA by small business owners. Okay. Now we're talking about contributing into an individual retirement account. Now, as you can appreciate, is that for those individual retirement accounts that receive contributions pre-tax, meaning you're able to take out that money, put it into the IRA before any tax is calculated, then if there was no restriction or limit on how much income, how much money you can put into the IRA, then you can understand. Some individuals would say, okay, this payday I'm getting $5,000 for my salary, and I'm going to put $4,000 in that IRA and only have $1,000 left for tax purpose. In other words, my taxes will be calculated on only $1,000. So most individuals would do that, and by doing that, and let us say that every pay period you do the same thing. $4,000 is always put into the IRA, only $1,000 is taxed. So you know what's going to happen by the time you retire? You go into a lump sum of money with interest earned that avoided taxes in the early days when you were at a higher tax bracket, and then years down the road when you are not getting distributions, and although it is being taxed, it's going to be taxed at this much lower tax bracket. And so you can understand it would be definitely almost an abuse of the system. So yes, so there are restrictions and limitations as to what your contribution limits are. And from time to time you will see, you know, hear on the news or see it in the publications where the income limitation and the contribution limitations would change from time to time. Usually they are held steady, but you know, periodically the authorities will say, okay, we're going to increase this a little bit from whatever it is to another number. Okay, so that is it, contribution. Now, although there are restrictions and contribution limits, it is still possible for individuals to over contribute, so to speak. Now, if you over contribute, yes, as far as tax deductibility is concerned, you will only be able to deduct for tax purposes whatever is the specified amount allowed. So the excess contribution, yes, you're not getting it as a tax write-off, but remember, that excess contribution is still going into the IRA account and is not going to be part of the total fund balance that is working to earn income for you. Follow me carefully. So you find that if you have excess contribution into your IRA account, you can't just put it and just earn income and say, okay, yes, I get away with that. No. So what you find is that the IRS or the Fed, the government, has imposed a penalty. A penalty. That's a penalty on excess IRA contribution. I call it a penalty, but it's actually a tax. So if you have excess IRA contributions, meaning that if you're only allowed, permitted to contribute, say, $7,000 for the year, and you decide, okay, I'm going to contribute $10,000. Yes, so you're allowed to contribute 10. You contribute 10, 7,000, is the limit of your deductions, if that is the case. But the fact is that extra 3,000 is in that IRA account, is working for you, is earning additional income by way of interest, dividends, whatever. And therefore, the IRS is saying, if you have excess contribution to your IRA, there's going to be a penalty in the form of a tax. In the form of a tax. And that tax is 6%. Okay? I'm just wanting to verbatim. The excess contributions are taxed at 6% per year for each year. The excess amount remains in the fund, in the IRA. Okay? So it's a 6% penalty, a 6% tax that you're gonna be hit with for any excess contribution into the IRA. So to avoid the 6% tax, what it means is that you just need to withdraw that excess contribution. And the literature is asking that this excess contribution must be removed from the account by the due date of your income tax returns, or if you had filed for an extension of time, by the due date as dictated by that extension. So no, your normal tax cutoff is like April 15th, sometimes different, like this is April 18th, but say it's April 15th. So you would have to withdraw any excess contribution from your IRA account by the April 15 deadline, so as to avoid the 6% penalty. However, if you had gone ahead and filed an extension or apply for an extension of time to file your returns, which would be a 6 months, taking you right up to about October, then you have that much more time by which you need to remove the excess contribution made to the IRA account to avoid this penalty. And remember now, if the excess contribution was, say, $2,000, you're not only required to remove this excess 2,000, but if the 2,000 earned some interest, dividend, or whatever, of $500, it means that the total excess in that account is the 2,000 plus the 500 earned. So you have $2,500 that needs to be removed from the IRA account to avoid that 6% penalty. This is really a tax. Just call it a penalty, penalizing you for doing that. Okay, so that's the contribution part of it. Very important for you to know that. And the temptation is to say, okay, any extra money I have, let me just put it in the IRA, man, let it work, let it grow, etc. and things. So, you may consider that the earnings that you're getting on that excess contribution, if you have to pay 6% tax on it, you don't mind it. Again, that can be a personal decision. You may say, okay, I'm going to put an extra 10,000, and if I see where I'm going to earn $1,000 on my 10,000, if I'm asked to pay a 6% tax, and let me just check this in, because the 6%, yeah, 6% tax, then you may consider to say, okay, yeah, but I'm still coming out with a net benefit. I don't know, but that's something you need to be aware of, just to be aware of it. Okay, let's look now at this other side with the withdrawal from your retirement account. The normal intention of any retirement account is that you should keep it, you should hold it until the day of retirement. Okay? It's not a savings account, it's not a checking account, whatever, for you to just put money in, take money out, put money. That's not it. It was the intention, whether it be a 401k or IRA, that's what it was meant for. Put money there in holding, earning more income on it through dividends, interest, etc., for you to get as distributions at time of retirement. But as I like to say, life happens and it's not always the case. So sometimes we find that we have to say, oh, I really need to go and get some funds from my retirement account, okay, from my retirement money. And so we do that. Now the rule is saying that at minimum, you ought not to withdraw any money from the retirement account before you are, or until you are 59 and a half years old. Okay? That's what the rule is saying. It is saying no, let it sit. So if you withdraw any funds from this retirement account prior to that 59 and a half point, then there's going to be a penalty. Basically, it's called an early withdrawal penalty. Good. Early withdrawal penalty. All right. But remember also too, and sometimes people get confused with that. I've seen so many of my clients kind of get confused, and this is what's happening. You go and you say to your plan provider, whatever, I need to withdraw $10,000 from my plan. Okay, you withdraw $10,000 from your plan, and what they do is to calculate 10% and put it on that form in the box called tax withheld. Federal tax withheld from the distribution is, let us use 10,000 what you withdrew. So you may find that there's $1,000 in that box, and that $1,000 is in the box marked federal tax withheld. And so you think that, all right, they have already taken the taxes from that, so I am done, I'm good. So when I go to prepare my taxes, there's no additional tax to consider. But no. What is happening? If you're less than 59 and a half years old and you withdrew that 10,000, although it is the 1,000, which is 10%, although it is reflected in the box called or labeled federal taxes withheld, the truth is that is really the early withdrawal penalty. What some distributors sometimes do, they will do a 20% withholding. And so once it's at 20% withholding, you can right away know that, okay, 10% of that is the penalty. And they also included additional 10% for taxes. It does not necessarily mean, though, that the amount of tax that you're due to pay on this distribution is just 10%. Remember, the first 10 is penalty. The second 10, and this is where 20% is withheld, the second 10 is tax. But they just arbitrarily use a 10% tax rate, because when you're doing your taxes, you may find that by virtue of your total picture, you actually fall in a 20% tax bracket. Or your effective tax rate may be 18%, whatever the case is. So although they are taking out 10% taxes from that distribution, when you do your taxes, when you come to do your taxes, the calculations will reveal that although they took 10%, because you have an effective rate of 18%, then that distribution is still short of tax withheld by an additional 8%. They took 10, you're in the 18% bracket, and so there's 8 more to go. And this is a general statement being made. Okay, so people come and say, okay, I've already paid taxes on it, why am I paying more? But no, quite often you only pay 10%, which is penalty. Where you have more than 10% withheld, which sometimes usually like 20%, it is 10% for the penalty, and another 10% withheld in lieu of the correct tax being determined at tax preparation time. Okay, good. So that is early withdrawal and the penalty. But of course, once you pass your 59 and a half, then you avoid the penalty because it's not early withdrawal anymore. However, the tax will always have to be paid because remember, if you put the money into the IRA account pre-tax, then when it's coming out, it has to pay its taxes. There are some exceptions that one can hang on to that will help them to avoid the 10% penalty. Several of them. One is that you have to make a withdrawal for medical purposes, and there are some rules guiding that. But generally, for medical purposes, for first-time home buying, for college education, for yourself, for your dependents, and maybe a couple others. But those are like the three key ones. Where if the early withdrawal is for those reasons, then you can get a waiver. You get a waiver of that 10% penalty. Okay, but remember, it is of the penalty. The tax is and will be due and withheld at the time, whenever at the time of the distribution, or when you go to prepare your tax returns, it will calculate whatever tax that you owe. Because sometimes you get distributions and there's nothing withheld, no penalty. If penalty applies, no taxes, and so you determine those things at the end of the period. The next thing and the last that we'll talk about here now is required minimum distributions. Required minimum distribution. And as the term says, that's exactly what it is. Retirement accounts have certain stipulations. It is saying once you reach a certain age, you are required to start withdrawing. It's called minimum distribution. You're required to start to take some minimum distributions. And if you fail to take those minimum distributions, you could find that again you are penalized in a way. That's required minimum distribution. What it literally is saying is that if you're age 72 or older, you must take your required minimum distributions. Okay, and that has to be done, before December 31st of each year. You have to take that minimum required. That will be determined. There's one exception to that rule, is that in the year that you turn 72, remember I said once you're 72 and above, you need to take. But the one exception or one little leeway is that the year in which you become 72, you can forego taking that minimum distribution for that year and decide that, okay, you're going to postpone it. And then we'll have to take it by April of the next year. But what that would mean is that in that next year, you're taking two distributions. You're taking distribution for last year that you forego because you're allowed to, since you're 72, and you're taking the current year distribution. Depending on the amount of money you're talking about, what you could find is that last year's distribution added to distribution and any other income that you may have would then end up putting you at a total income that cause you to even go up into a higher tax bracket. So that again is touching a little bit on tax planning, meaning that you, in a general sense, it is the managing of your income flow, of your distribution flows in such a way that no single year is overloaded, meaning that you're reporting a lot of distribution, income, whatever, which will effectively push you up into higher tax brackets. So you want to sort of smooth out, level out the thing. So if you opt to go the route of, at 72 years old, I am postponing that required minimum distribution, then you would have to take it next year, but then next year you will have double distribution, so you could end up in a higher tax bracket. Okay, so that's one of the things. So that's a required minimum distribution. It applies. So that's about it in terms of the general structure, of IRAs, what they're about. You know, what's the purpose, how, you know, how the administration, or the little, let me call it, the differences, you know, the nuances between one type and the next one type. But as usual, our forum here, our video cast here is just to expose you and to make you be aware of the things that are available, how they work in a general way. But once you are interested in exploring for yourself, hey, maybe I should go and, you know, take out an IRA, I would say, do not just run up to your broker firm or your bank and say, I'm here to take out IRA, and the man say to you, okay, what kind of IRA you want? And you say, boy, the first one that comes to mind, no, give me a Roth. No, you're not buying grocery. You're not going to the shop to buy buy grocery or to buy toiletries. Say, oh well, yeah, any roll of tissue will work. No, that's not how it works. So you need to be informed. Okay, you need to do additional investigation, get additional information and facts, so that you're guided and you end up with the correct plan, so to speak. Okay, good. So that is it. That's our tidbits this evening for individual retirement accounts. Very, very important, especially for those of us who are self-employed, and at the end of the road there's nobody, company to look to and say, okay, it's no time for me to get my distributions. No, there's no such. So you have to build your own little safety net, and the IRA is the way to go. A lot of people say, okay, no, I will just invest in, you know. So yes, I don't see investing to earn bigger bucks is a substitute for an individual retirement account. You can have them both, you know, why not? All right, so that's it for today, and thank you for hanging with me. And I remind you, check out my YouTube channel, because all the Tuesday video casts that we do are posted on my YouTube channel. So if you miss something, you want to do a recap, you can always just check it out and you will be brought up to speed. And of course, there are a list of other videos on all the different topics that we have covered, and it's quite a bit. So check out Etienne Business Solutions, the company, the website. Check out Etienne's Place, the YouTube channel, and be informed. So that's it for today. God bless. Take care of yourself for the rest of the week, and we'll be back here next Tuesday at 8 p.m. for another session, another video cast at Etienne's Place. Bye for now.